Hello and welcome to Quilter Cheviot's Market Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, to be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Fraser Wilkinson, Investment Manager at Leeds, based out of our Leeds office. This week, I'm pleased to be joined by Ben Barringer, Equity Research Analyst here at Quilter Cheviot. Good morning. Well, it's been quite a week last week, and there's a lot coming up this week. I think one of the main things that is capturing attention is debt levels in the UK and the US. Government debt seems to be rising inexorably higher. According to the Office for National Statistics, the UK government debt equates to £38,615 per person, per man, woman and child. The USA is not to be outdone, and according to the US Department of Treasury, the US federal debt has risen from $1.6 trillion since the 1st of July. That's $4,771 additional borrowing per US citizen in about 3 months. In total, US federal debt equates to $100,226 per citizen, and it certainly doesn't feel like spending is about to drop. It doesn't feel like a huge increase in taxes will fill the gap either. So we are looking at a huge amount of fresh government borrowing, both in the UK and USA, to be required. Unfortunately, at the same time, we're in a new interest rate paradigm. Gone are the days of 0.1% base rates, and current base rates in the UK are 5.25%. Simply paying the interest on this debt will be more expensive going forward, which is likely to lead to even more borrowing required. At the same time, we are in a fight against high inflation, and we appear to be facing higher for longer interest rates. As a result, we've noticed fixed return assets like government and corporate bonds, as well as assets that produce most of the return through an annual income, such as infrastructure and utilities, have been very much out of favour as their price has had to adjust downwards to a point where their annual income is attractive compared to available cash rates. Now, in contrast, growth assets have been relatively more favoured recently, particularly with revenues often rising in relation to general inflation. So as a result, I'm delighted to have our technology equity analyst here, Ben, for the viewpoint on what is often viewed as the ultimate growth asset, technology shares. So as a first question, Ben, can I ask how rising interest rates and high inflation recently have affected the valuation of technology shares generally?
Yeah, good morning, Fraser. And yeah, thanks for the question. Thanks for having me on. So look, rates are super important to long duration assets, and very high growth, often unprofitable tech has long duration. And so it is a very much a key feature when you're looking at technology. Let me just summarize how I think about things you need to think about in terms of tech investing. You need to think about the fundamentals of the business, what's happening to the top line, what's happening in terms of macro, because tech is cyclical, but also in terms of, what gearing to profitability they're getting as well. So fundamentals are very important. The second thing that's important is how tech compares and the growth in tech compares to other areas of the market. And we saw that during COVID in 2021, tech had very strong growth driven by us all using PCs and the cloud and so forth, versus most other sectors that were not growing. So tech did very well. Back in 2022, that situation reversed a little bit in the sense that there were lots of sectors of the economy that were recovering. Travel is a very good example. But there was also, quite a lot of energy growth in the energy stocks as well, as energy prices rose, and so that meant tech underperformed. As we came to 2023, tech has re-established its sort of growth premium over other sectors, and so we watch that very closely as we head into 2024. So that's relative growth. Then the final piece is obviously interest rates, and interest rates, as I say, are a discounting mechanism, particularly for long duration assets, and we have to be quite careful in tech because the very, very long duration assets, so the very high growth, often small software companies that are often unprofitable and are just going out and out growth, are not a particularly desirable area for us. We much prefer growth at a reasonable price, companies that are growing something between 10 and 20%, but have reasonable valuations, have often cash on the balance sheet and good levels of profitability. You could go really short duration, in which case you could go into some of the cheaper technology shares. The problem problem with value investing in technology is often you're investing in companies that are being disrupted by newer companies, and so the earnings that they apparently are going to make, that make them very, very cheap, are often declining or being disrupted, and so you have to be quite careful. So we try and occupy this middle ground as sort of a medium duration within tech. But yeah, look, interest rates are a issue for tech investors, and in fact, that move up in bond yields recently hasn't really been fully reflected in the Nasdaq. So it's certainly a risk as we look into 2024.
Balance is key, as ever.
Absolutely.
To the casual observer, your sector can often be viewed as all very similar, which I know you'd vehemently deny, because in reality, there's a whole ecosystem of different assets, from, I guess, highly speculative growth shares to solid, dependable earners, as you've discussed. Could you perhaps give our listeners a flavour of the different types of business we can choose from within the tech sector that we buy?
Yeah, absolutely. So I think I'd probably break it into 5 simple subsectors. The first one would be software. And again, you get these very high growth software companies, and then you get sort of more dependable software companies like Microsoft or Intuit or Salesforce, which we quite like. Also within that, you get companies like cybersecurity, which we really like as an area as well. The second area would be some of the cloud infrastructure providers. So that's companies like Amazon with its AWS offering. It's like Microsoft with its Azure offering, and then Google with its Google Compute platform as well. So the cloud has been a structurally growing area of tech. So that would be my second area. The third area would probably be semiconductors. Semiconductors are obviously used in all kinds of different applications. They're used in PCs, laptops, they're used in smartphones, they're used in the cloud, and so on and so forth. And so semiconductors, really saw that big shortage during COVID. That's starting to sort of rebalance now. And the problem with semiconductors is there's always a trying to find the balance between demand and supply is quite difficult. Demand varies, obviously, with demand for the end products, and it is macro sensitive. But supply, because it's quite, to build a fab. Fab is a factory that makes semiconductors. To build it takes about 3 years and costs upwards of $10 billion. And so to do that is quite chunky. And so you get these very chunky supplied additions and supply contractions within semiconductors. And so the driver or the balancing item is always price between supply and demand, but it can make basically semiconductors quite volatile. 3 areas you need to think about within semiconductors. I always think of this like the brain, really. You've got logic, which is the bit that does all the compute, all the processing. You've got memory, like we have in our brain, that holds on to the data or stores all the data. And then you've got sensors that basically give inputs and sometimes outputs to the brain. So think of it like the eyes and your hands and ears and so forth. So that's semiconductors. The fourth and fifth piece, I think, is sort of the digital advertising side. So that's companies like Google and Facebook, now Meta. You've also got Netflix in that bucket. You've also got smaller digital advertising companies like Pinterest, Snapchat, and then companies that are more regional. So companies like Auto Trader or Rightmove in the UK. So that's the internet piece. And then finally, consumer electronics, right? So companies like Apple, Samsung, companies like Hewlett Packard that mainly make, PCs, laptops, Dell, things like that. So yeah, that's how I would portion it into those 5 pieces. And within that, you've got a whole spectrum of growth and profitability. Our general way of trying to find companies is looking for companies that can deliver that 10 to 20% growth year in, year out, and sort of hold their multiple. The simplest way to think about it, Fraser, is if I can find a company that's growing 20% that stays at the same sort of valuation year in, year out, the share price should grow 20%. It's not quite that simple, but that's a simple way of thinking about it.
Absolutely. That's what we're after. Now, we're very lucky to have you at the moment because we're right in the middle of earnings season for your sector. And so we've got a lot of results that come out recently and a few more this week. Can I ask, so far, what are your highlights and what do we have to look out for the rest of the week?
Yeah, look, so last week the main highlight was probably Netflix. Netflix delivered a much better than expected set of numbers. Remember, Netflix has been growing very strongly, up until COVID. COVID was then the perfect, environment. If you didn't have Netflix during COVID, that was you're probably never going to have Netflix, and so that meant that their subscriber numbers topped out and they stopped growing. They've since decided to do two things. The first one is clamp down on password sharing, because at the time, a couple of years ago, they had about 220 million subscribers. And they have indicated that there were a further 100 million subscribers or users of the service that weren't actually paying for it. So my parents, for example, and I'm sure you've all got people who use your Netflix account. Those were people who could potentially be come onto the service and be paid. So that's the first driver, and they've started to sort of pull that lever, and so that's helping subscriber growth. The second area is that you will be aware that Netflix doesn't have adverts at the moment, and that's one of the benefits of the service. But they've also, in these cash-strapped times, introduced a service that is ad supported. So you pay less money, but you see adverts, pretty much like traditional television, but on the internet. So it's very much a move back, if you will, to more traditional type of television, but with advertising just being streamed. And so that they're starting to see a benefit from that. So that was the real highlight for me. You had sort of, in the semiconductor area, you had a business called ASML, which makes the machines that make semiconductors, and you had TSMC, the world's largest foundry, the world's largest maker of semiconductors. They're a bit more muted in their outlook because macroeconomics still haven't improved for them. They've seen the downswing and this adjustment in supply and demand, but the macro is still an uncertainty for them. So people are waiting to see how 2024 works out for them. So those will be the highlights and the lowlights, Fraser.
What have we got to look out for coming up?
Yeah, absolutely. So look, this is a big week for tech earnings. We've got companies like Microsoft, Meta, Google, Amazon, and we've also got Apple soon as well. So let me try and talk you through some of the key things I'm going to be looking for in these results. The first one is obviously what's top line revenue growth looking like during Q3, but also into Q4 and then into 2024 as well. And I think there are three things you need to think about in terms of top line for the big tech companies. First of all, what is IT spending looking like? Macro, IT is a cyclical, and so IT spending's been coming down from about 5% to around 2.5%, 3%. But is there further downside in that, or has it stabilized? And we think it's stabilized from looking at CIO surveys. The second area would be cloud growth. I mentioned that this is a big structural change in terms of IT, and companies like Microsoft Azure and Google Compute should report cloud growth of around 25%, something like that. The biggest player in the market is actually Amazon Web Services. That should be about 12%, something like that. But what we're really looking for is, what's been the drive from AI, but also how much has macro impacted cloud spending, because again it is cyclical. The third thing that's going to impact top line is for the companies like Google and Meta, and that's digital advertising. What have been the trends in digital advertising? And actually there's been quite a big shift continuing on from traditional linear television, so over across to digital, and also quite a lot of particularly consumer goods companies, their advertising budgets have been pretty good. So Google's expected to report something like a 10% revenue growth, Meta probably more like 20%, as they introduce things like Reels and Threads into their product lineup. Second thing I would like to talk about is AI, because that's been a huge driver of tech through 2023. The big things we're going to be looking at is Microsoft, and they've got their release of their Copilot set of products. So Office Copilot, so Word, PowerPoint, Excel, and so on, are going to have generative AI infused into them, and they're going to be charging $30 per month per user for that product. What's going to be the uptake of that? Are people seeing the real benefit to pay that what could be described as quite a chunky increase in price for using the Office suite. Second area in terms of AI demand would be, how is AI being used in digital advertising, particularly for increasing targeting and improving content generation, and then what's been the availability of the semiconductors to do AI, because the key company that's been able to produce the chips is Nvidia with their GPUs. Can these big cloud providers get hold of the GPUs from Nvidia, and what efforts are they making to diversify away from the dominance that Nvidia has, either doing their own chips or using other suppliers like AMD. Final piece I would think that I'm looking at is cost growth. What are the capital expenditure plans for these companies? Typically, capital expenditure for the big cloud companies and tech companies has been running at about 15%. But what does that mean for, and what's the mix of that? What are the signs for the various component suppliers? Also, during 2023, we've seen quite a high degree of agility in terms of cost management from the big tech companies. I think it's one of the key reasons why we like them. And you've seen big headcount reductions at companies like Meta. Google's also had some, Microsoft as well. What's the trend into 2024? Are we going to see further headcount reductions, or actually it seems like there is a little bit of a sign of employment in tech improving a little bit? So that's close to be watched. But I think investors are largely content with what's happened in 2023. Everybody's focus, as is often the case at this time of the year, moves into what's going to happen in 2024. And obviously, investment is all about thinking what's going to happen in the future and where the puck is going to be. 2024, I think, is now going to be the focus.
Well, double-digit revenue growth sounds a good start to me. So yeah, sounds pretty exciting for some of those stocks. Now, last question. Sadly, our ever-present geopolitical tensions seem to have erupted into full military conflict in various parts of the world recently. Can I ask what part the tech sector is doing in efforts to make the world a safer place?
Yeah, unfortunately, Fraser, geopolitics is an increasingly important part of our job, and we have this issue with semiconductors and the geopolitical tensions between the US and China, which are making some restrictions on various chips into China. We also have the potential conflict in Taiwan as well. TSMC, Taiwan Semiconductor Manufacturing Company, is the largest provider of chips, and so any invasion or disruption in Taiwan would be a big issue. And then moving to the more current issues, Israel is a big tech hub, and so there are quite a few companies that have R&D centers, particularly in Israel, and so that's a problem for some companies. Actually, particularly the cybersecurity companies. There's a lot of know-how that comes out of technology out of Israel as it relates to cybersecurity. So we don't actually have any Israeli companies under coverage, so it's not a direct impact, but there is going to be some disruption to a few companies. In terms of making the world a safer place, there's not a lot of defense spending. It's a small part of overall semiconductor manufacturing. I would argue, where tech does play a role is certainly in cybersecurity, and cyber warfare is increasingly a weapon of war. So it's one of the reasons that we think cybersecurity is a really great place to invest. Cybersecurity budgets generally go up because the threat in cybersecurity is constantly evolving, because ultimately the adversary is a human, and they are constantly evolving, and so the threat has to evolve. And so you find that tech budgets for cybersecurity go up, but they rarely go down, and because the risk is constantly increasing. So yeah, I would argue that cyber is probably the best way to characterize the way that tech makes the world a safer place.
Well, thank you very much, Ben, for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your socials, and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We will be back next Tuesday, and in the meantime, head over to our website, quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. And finally, do you have any questions that you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website, and we'd love to hear your questions. That's it for today. So thank you, Ben, and your time today, and all of you for listening. See you next time.